Hey everybody, JJ here, back again with another Wednesday of Zoom networking. Have another special call for you with a very special guest. Um, the young man speaking today for us is from Sweden. He's international, but more than that, he's just an exceptional person. He's also my accountant, my very good friend. He's a family man, he's a businessman, runs an accounting firm. He's a dad, got two beautiful boys. I'd like to introduce my very good friend, Mr. Nareg Niazi. Nareg, how are you?
Thank you so much, JJ. I'm good. How are you doing, JJ?
I'm good, brother. I'm good. I'm like your office there, which I've been a number of times. For those that don't know you, where in the country are you located?
I'm located in Glendale, California.
Which is a beautiful place, not far from Dodger
Very,
Stadium. I'm like, go
very close.
Dodgers. So, we're gonna talk today. Your topic is gonna be tax rules and benefits related to real estate, which is
Correct.
huge. Um, Really quick, how long have you done business accounting? You've been my accountant for many years, probably, I just say in excess of 20 years. You've been my business accountant,
Yes, a lot of years. Yeah, at least 15 years. So I got into accounting because my dad was an accountant. I started with accounting very early age. I want to say I was 13 years old, 13 or 14 years old. Um, I obviously went to the university, got my master's degree. Then I started working at Deloitte and Touche in Stockholm, Sweden. That's where I grew up. And then after that, I transferred to the LA office, Deloitte LA. And then I joined this firm, and now I am the managing partner at Niazi CPA Group. So I've been doing this most of my, pretty much my whole life.
There you
Yeah,
go.
and
There
I'm
you
40
go.
now, so it's been 27 years now.
Oh my God, you're getting so
Yeah,
old. Getting
yeah.
so old. Hey, so real estate. Like
Mhm.
I'm a real estate investor, and you're now helping me way beyond what you were helping me previously, which was just as a landlord. I came to you as a landlord and just family holdings, and you're helping with those tax issues. But now as an investor, you're able to help me in even more ways. And I guess, from your standpoint, there's probably a lot of things that most investors don't know. Is that correct?
Yes, I believe so. So real estate accounting and real estate taxes, that's a big passion for me. And I think there's a lot of tax benefit and tax rules, investors and real estate owners could benefit of, but they don't know about it most of the time, or they have, the wrong information. It could be anything. I would like to talk about like I want to say six of the main rules I like today. And we could go topic by topic, but these are the rules I think are very important to take advantage of if you are qualified.
Well, and as we talk about the rules, I mean, something comes to my mind, and I think this is one that you're going to talk about today, but I kind of want to hit it right off the bat because I mean, I don't know all of them, but I think I know
Yeah,
one of them. And
yeah.
the one I wanted to ask you about is 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 this one of the rules? Is the Augusta rule? Is that one of the rules?
Mhm. Yeah,
I,
yeah. The Augusta rule is one of the rules I wanted to
I've
actually
heard
discuss.
about that,
Uh-huh.
not knowing a lot about it. When it gets explained to
Mhm.
me, I kind of go, oh yeah, now I get it.
Yeah.
But what is the Augusta rule?
So the Augusta rule is actually named after Augusta in Georgia, where homeowners rent out their homes during the Masters Golf Tournament to visitors. So it could provide a legal way to earn extra tax-free income. And I want to say it's especially useful for homeowners in areas where you know that there's a high like short-term rental demand, right? So like uh, during certain periods, you could rent out for a pretty pricey nightly fee for the rental. And it was initially introduced to just encourage short-term rentals. Um, so the Augusta rule applies to primary homes, right? Primary homes, which is your main home you're living in, or a vacation rental. So you could have like sorry, not a vacation rental, but a vacation home, but it could be secondary. So for those two, So primary residence and vacation homes, if you rent those out and you have rental income earned for up to 14 days per year, then it is not reportable as taxable income. So up to 14 days per year, you could rent it out and not get charged any tax, and you don't even need to report it. So that's the benefit of the Augusta rule.
Wow.
It could also be, let us say, you have a business, you have your own law firm, right? And you want to throw this big event, and you want to rent out your home, again, your main home, right? You live in for a big event for the law firm, a holiday party, something like that to promote the business. You can collect rent, a fair rent from your business expense it, but you don't need to pick it up. So there's a few ways of using this rule to your own benefit. Again, it's per the tax code, so there's nothing wrong. One thing to keep in mind is it has to be up to 14 days a year.
Let me ask you,
Cannot
uh,
pass that.
does that also have some consideration in certain city, county, municipality regulations? I believe City of Glendale doesn't allow Airbnb, for example.
Yeah, so city rule, so this is the federal tax rule, right? So and city rules could be different. Some states might not conform it. I know California conforms to it, but this is the actual the that you don't need to report the taxable income, right? Because it's not taxable up to 14 days. Certain cities might have like a rental permit or things like that. Yes.
And on that same, let me ask you, I've got a house I'm working on moving into, the one that, I'm building. If I rented that out for a photo shoot or for a music video or for a commercial,
Mhm.
as long as it's less than 14 days, it's the same
Yeah.
thing. Doesn't have to be
Yeah.
someone renting it
Yeah.
for lodging, but they can
No.
rent it
No.
for a shooting.
Yeah.
Okay,
You're
great.
you're very correct. So the dollar amount doesn't count. It's the days. So and it's very common here in our area, right? Los Angeles, Glendale, Hollywood. As long as it's under 14 days, you don't need to report it.
Now, if you hit over the 14th day, then you do report all 15 days or just that one day over the 14th.
Yeah, once it passes that, then it's the Augusta rule is gone. Then it's just a rental, all of
So
it.
then you have to
It's a
report
rental.
all the earnings.
Yes, yes.
Okay. What's another
Yeah.
rule that we have? What's another one that you want to share with us?
Another one I want to share, which I think is very interesting. A lot of people follow this online. They read about it, they hear about it. Uh, Real estate professional. So the real estate professional rule, what is that? What does that mean? So in general, rental activity is considered passive, and any rental losses you incur um, can only be offset against passive income, right? So in any given tax year, let us say if you have income from non-passive sources like W-2 wages, uh, K-1 ordinary income from pass-through entity, or you're a sole proprietor, you work for yourself, you have a Schedule C earnings. The rental loss cannot be used to reduce the resulting taxes, right? It can't offset because it's passive. Instead, it will be suspended and it will be carried forward until you either dispose of the activity, you sell your building, or you earn passive income from another rental or a future year. But if you do qualify as a materially participating real estate professional, your rental income or loss is considered ordinary, right? Rather than passive income. So once it's considered ordinary and you have active or material participation, it allows you to offset potential rental losses against other ordinary income sources, such as I mentioned, wages from an employer or your sole proprietor income or your medical practice or law practice income. And this could substantially lower your tax liability. I think a lot of taxpayers don't know how you qualify. What does it mean? Who can be a real estate professional? So in order to qualify as a real estate professional, well, like tax-wise, right? a taxpayer must meet both of the following criteria. So the taxpayer must perform more than 50% of the services in real property trades or businesses in which they materially participate. So more than half of the services or work they do on daily basis has to involve real estate. That's number one. Number two is that taxpayers need to perform at least 750 hours in real estate
In what time
um,
period
per year.
per
So,
year?
and this is the thing, like someone who works full time, they work about 2,000 hours, right? So to say that, okay, I put 750 hours, sure, maybe you do that, maybe you do that at nighttime, right? But again, you have to also say, okay, 50% of the time I work, my services has to go to real estate. That's the tricky part. And it gets trickier because let us say, okay, to substantiate both of these criterias, it would be hard if a person, or I guess both spouses, if you file married filing joint, have a full-time employment somewhere and which is not related to real estate. That's going to be hard to substantiate that, you know, you put more than 50% of your time into real estate and 750 hours. But there are times you could use this. So let us say if you are filing a married filing joint return, right? Two spouses. One spouse is, I like to take, law firm and medical practitioners as an example. It's just us. We have a lot of law firm clients and doctors and real estate. So let us say that the one spouse is fully involved in the law firm and the other spouse focuses on the real estate activities, such as rental of the mutually owned real estate, right? So they own rentals, and the other spouse is working on those and managing those. And this would be an excellent option to use to offset the rental losses towards the other spouse's earned income from the law firm, right? So one has, wages and past rented income, ordinary income. The other one is qualified as a real estate professional and manages the joint properties. And we will discuss what ways, a rental property could actually show losses, right? I'll get to that too, but that's an excellent source of offsetting expenses or losses, passive losses, which is no longer passive, they're actually
Hmm.
ordinary losses
Cool.
because you are a qualified real estate professional.
Are you limited to the number of times you could do that? Or you just have to make sure that the length of time is less than 14 days?
So per calendar year, it has to be 14 days, right? So the next year you could obviously do it again. So as long as per calendar year doesn't exist 14 days, it could be, 3 days now, 5 days
Oh,
next month, six,
okay.
yeah. It
Yeah,
just
that's,
can't add up to more than 14 days total per year.
yeah, for a second I was getting excited. Like, what? You could rent it out for 12 days, 100 times a year? That would be great.
Yeah, no, 14
JJ, I was
days
thinking
total
like
per year.
JJ's probably losing his mind. You know,
There you go.
okay. Okay, hey, thank you.
Of
Thank
course.
you,
Thanks for the
Paul. Thank you
question.
so much. Panther, you're on with Narg. Do you have a question?
Yeah, I was wondering, like, how do you prove that you've put in all of these hours to be a professional? Like, especially if you don't own any properties yet.
I guess what would you deduct then? Like what losses would you actually incur if you don't own any properties? Right?
Uh,
Because the benefit is that when you have properties, mutually owned properties, that you actually have losses and you want to offset other income. But if you don't have any properties, you don't really generate any losses either. But once you have properties, that's a good question. So you need to technically actually keep a logbook. So I've actually seen in audits where they ask for the logbook. They might ask, how often do you actually go or visit these buildings or apartment buildings? Is it, once a week or is it actually five five days a week? But logbook is the answer.
okay. I was just curious. Yeah. I mean, eventually I'm going to own some properties, but
There you go.
leading up to it, I do put in a lot of hours, and I do
Yeah,
keep a lot.
and it's actually on yearly basis. So let us say if you did put a lot of time this year, and less, next year. So each year you kind of have to qualify. So
Got
that's
you.
very important to consider that you have to put your 750 hours per year.
So, and
Okay.
then, Nareg, as you're saying, if Pansy doesn't own property yet, but she's on that road to acquire and build a portfolio, it's probably a good
And
exercise
that's very
now.
common. Yeah, and that's very common. Like a lot of taxpayers have that goal. They want to be an investor. They want, and you slowly build it up, right? It's not like all of a sudden 1 year you have 5 properties, but slowly but surely. And the more properties you have, what happens, you do a grouping election, so you group them together, and together it's easy to get to those hours.
Okay. All right.
Yeah.
Thank you. I appreciate it.
Thank you for the
Thank you,
question.
Pansy.
Thank you.
Good, great question.
Yeah.
So we've covered now the Augusta rule. We've covered now being a professional and what that entails, with like 750 hours working a year.
Correct.
And then people need to track that. I mean, even like in Pansy's case, even if they don't own the property yet or they're working towards that, it's probably just a good exercise to
Yeah.
track those hours
I
worked.
think it was a very good question. Yeah, I mean, how do you keep track on it? So a logbook would be great. Set something up very easy. It doesn't need to be too crazy. I mean, it could just be, like a calendar almost,
Yeah,
or
and I
weekly
believe,
logbook.
Brian McDowell, who's in our group, has actually built an app to track hours, and we can chat about that. But
Yeah, Brian is my client, so I'm not surprised.
Most people don't realize the time to have this discussion with someone like you is the season before they need it.
Oh yeah, you're very right. So once the year has passed, a lot of things, I mean, there's certain things you could still do during tax season, but at our firm, we try to strategize and kind of plan this beforehand, right? Because there's certain strategies you have to use and advise and plan for. So it's very important to do this before year end, obviously. Yes.
Narg, what's another strategy we might want to pay attention to?
Sure. So there might be times where you don't meet this hour, and but you still kind of don't want to treat it as passive rental. So there might be other options. One is self-rental rules. So self-rental occurs when a business owner rents property they personally own uh, to their business. So as an example, again, I'm going to bring the medical doctor or attorney, which owns a commercial real estate property, right? They own a commercial building individually, and they rent it out to their medical practice or law firm. They might own this real estate, under a separate legal entity. It might be an LLC, which is very common for rentals, right? Or real estate. So, and the practice might be another entity, commonly like an S corporation for the service industry. So the LLC rents out the building to the S corporation, right? The rent paid by the business to the owner is deductible. It's a business expense, lowering taxable business income, and is reported by the property owner as rental income, right? But as the property owner, you could claim expenses and depreciation on the rental property, which reduces personal taxable income. And this is the key. Generally, rental income is considered what? We discussed this earlier, passive income, right? But under the IRS self-rental rule, rental income from a property leased to your own business is considered non-passive, which means a taxable loss from the rental activity can be offset towards the ordinary income. So let us say your rental activity, your commercial building, after depreciation is showing a loss, you could actually offset that to your ordinary income. So this is another way of the passive rental is no longer passive. It's actually considered an active loss. One thing to consider is that obviously the lease agreement between you and your business is well documented, and it has fair rental terms and fair rental market rates. So that's important to consider.
Yeah, so is this the kind of instance where someone has commercial property and they're actually putting one of their businesses in one of the units?
Hmm. You could do that too. You just need to allocate that, right? So that portion of the building could be self-rental rules. You could apply self-rental rules. That's actually a very good question. So we have those cases. Yes, you might use, half of the building for your own use, right? That portion is considered ordinary. So the loss, you could actually offset it towards your wages and your other business income. The other portion is still passive because you don't meet, the real estate professional, uh, you know.
Okay. Now, these rules, obviously, not every rule applies to every single person. Are some of them more common, some of them less common? I mean, what would be the next rule that you'd like to share with us?
Um, I think certain ones are more common. Like I think the real estate professional rule is a common rule we just discussed earlier. I think the self-rental rule is also very common because a lot of times established taxpayers where they have their own practice, they might ask, okay, what can I do? I want to save taxes. I also want to have a good investment, right? I want to have something where I could defer taxes, but I want to invest. I want to have good cash flow, and they might buy a building and rent it out to themselves. Now, one rule, I guess this is rule number 4, if I'm not wrong, um, is short-term rental rules. So this one is actually less common, but it's a very interesting rule. Short-term rentals, so this is just for short-term rentals with an average rental stay of 7 days or less. The IRS treats the income as active business income versus passive rental income, which can only be deducted again toward passive income. A taxpayer can use this tax benefit to deduct the rental losses from the short-term rental to, again, wages and other business ordinary income.
Okay, that sounded pretty juicy. Give that to me one more time.
So what's important is that the average rental per rental, the average rental stay is 7 days or less. That's the rule. So, but that's the average. Remember, it's an average. You might have a 10-day rental, you might have a 15-day rental, but you might have 30 other ones per year, which are just like 2 or 3 days. So that means your average rental is still 7 days or less. So that's number one. It has to be 7 days or less average rental stays.
Per month.
No, per year.
Oh, per
Per
year.
year, right? So you look at all your short-term rentals, let's say if it's Airbnb or whatever platform you're using, and once you add all your rentals, let's say you had 30 different stays, right? 30 different bookings. Some might have been 5 days, some might have been even 15 days. But once you average out all the rental days divided in the bookings, right? The stays, and as long as you get to 7 days or less, that means it could qualify for a short-term rental. Now, there's the only thing is that to qualify, there is a 100-hour rule. So remember we talked about that 750 hour, which is harder to meet, right? But this is a 100-hour rule. So during the year, if you've put 100 hours and no one else, such as a property manager or tenant, have be more involved than you. What does that mean? So let us say if you put 100 hours, but you actually have a manager on spot or every day they're there, or you have a tenant who does all the managerial duties, you do not qualify. But if you do put 100 hours and there's no one else who puts more hours or have more involvement than you do qualify. So this is actually an excellent option for people who have time and they want to do short-term rentals of a real estate they have bought, as long as they, honor that 7 days or less average rental stay or days per rental, they could qualify. So this is a way of kind of going around it. This is another way of treating it as ordinary losses and not passive losses. You might have a job where you actually have time and you could do this on the side, at nights and, take care of bookings. And it's an investment, but it might actually show a taxable loss at the end of the year due to depreciation or accelerated depreciation. And that loss you could actually offset towards your regular income, your wages, and pay less taxes. Now you have an investment and you save on taxes.
Do all accountants know? I guess they have to have some sort of background in real estate, right?
Yeah, I do like real estate a lot, so I know a lot about it. I can't say that all accountants know about all these rules. I like to apply them. I like to, when I sit down with my clients, actually go through and see what could apply to them. Now, doesn't mean all of the rules apply to them, right? But we're seeing that there's different rules. One might not, but the other might.
So,
And
just like someone getting an attorney, there's a divorce attorney, there's a probate attorney, there's a, real estate attorney, there's different types of attorneys. There's also accountants that have different specialties. Is this correct?
yeah, or they like to focus on different things. So we have clients in a wide range of industries. We actually have different clientele, but I want to say most of our clients, the majority, they're professionals, and real estate professionals, especially. Yeah.
Cool.
Um,
Do you have another rule you can share with us?
sure, why not? Let's do it. We talked about accelerated depreciation. You might have heard about this before, but a cost segregation study.
What
So
is that?
yeah, so a cost segregation study is a tax strategy used by, again, real estate owners to accelerate depreciation deductions by reclassifying certain components of the property. So instead of depreciating property over 27 and a half years, so real estate property, residential properties, you could depreciate over 27 and a half years. Commercial real estate, you could depreciate over 39 years. But instead of doing that, a cost segregation study breaks down the building's components into different categories, right? And allowing some assets to be depreciated over shorter terms, like 5 years or 7 years or 15 years, right? So let us say if you have the depreciable value of a property you buy. In our area, I want to say 50%. I mean, this is just generally. Typically, it's around 50% building. Let's say the other 50% is land. Let's assume it's 50% building. That 50%, instead of depreciating it over 39 years, if it's a commercial property, you could actually segregate that and divide the cost in different categories. And that way, what you're doing is you're actually accelerating your depreciation. So you just reclassifying parts as, lighting, plumbing, landscaping. This would allow faster depreciation and larger tax deductions in the earlier years of your ownership, right? So in the earlier years, it goes more aggressive, which, by deferring taxes to increase depreciation, the owners can improve their cash flow. This is often used for newly purchased buildings. They're renovated or, constructed buildings, but it could also be applied to older buildings. So just to summarize, like a cost segregation study, it helps the real estate investors to reduce taxable income and increase cash flow by identifying property components that can be depreciated more quickly. So, and it depends on like the percentage of assets that can be classified or reclassified as personal property and land improvements will depend on the type of the building. So some rough estimates, right? Like you look at the building, depending on the type of the building, a certain portion or percentage you could reclassify to shorter life property. Like apartments, you could maybe reclassify about 20% of the building value. Hotels, I want to say about 30, up to 30.
Mm-hmm.
Office buildings, which is a common one, right? People ask, okay, if I buy a practice, building for my practice, I want to say it's 10 to 20%. That's common. Grocery stores could actually be up to 25%. One thing which is interesting, warehouse again, 10 to 20%, but the one where you could actually recategorize the most is manufacturing. So because just think about it, like a manufacturing warehouse, like they have all these other equipment, right? Like it could be fixtures or things like that. So that one could go all the way up to 50 or even 60%. And that could give a lot of tax savings to actually accelerate depreciation.
Great. That's awesome. Do you have another rule for us at all? I mean, yeah, you got. I'm trying to keep track of all the gold nuggets you're dropping here, all the
Sure.
information. I'm not sure we're at five or if we're at six right there, but I know you've just been
I
in and
think I
out.
have one rule. I think it's the last rule actually, number six, topic number six. So like-kind exchanges, 1031, code section 1031. I'm sure you've heard about this one, JJ. So 1031 exchange, again, also known as a like-kind exchange, allows real estate investors to defer paying capital gain taxes when they sell an investment property and reinvest their proceeds to a similar property. Now, what is a similar property, right? Um, they have to be of the same nature and character, but they don't need to be identical. So it has to be real estate exchange to real estate, but it could be a commercial building you exchange for a single family home,
Okay.
or it could be an apartment building you just exchange to land or a retail store. So
Does that have to be done within the same calendar year?
it does not. No, it does not to be done within the same calendar year. But that's a good question because I want to talk about there's certain days and periods we have to honor. So one thing before we talk about the days is so both the relinquished property, which is the property being sold, and the replacement property, the purchase property, they have to be held for investment purposes, right? And used in business and trade. So it can't be your main home. A lot of people think like, oh, my main home or my secondary home. No, you can't do 1031 on your main, right? It has to be business property. Your primary, right? Your primary and your secondary, you cannot because they've never been business property. You've never rented them out.
Got it. So you can only
Um,
do that in regard to a business property.
correct,
Great.
correct. And the new property you buy has to also be business property, right? So you can't all of a sudden buy it and then say, "Oh, this is my new primary home." No, you cannot
So
do
like
that.
shopping centers basically or
Yeah,
multifamily properties.
yeah. Rental properties. So that's that. One thing to keep in mind, which I think is very important, there are certain deadlines which are very important to honor. Um, so after selling the original property, you have 45 days to identify a potential replacement property, right? Some property you want to buy, and it has to be in writing. And you could actually identify a few. Let us say one doesn't go through, the other one does. So that's very important to know the 45 days to identify a potential replacement property in writing. And this is a strict deadline and it includes weekends and holidays. So you can't consider Saturday and Sunday and say, oh, yeah, I met the deadline. Like it's every day, 45 days identification period. The next period I want to talk about is the 180-day exchange period. So the exchange must be completed within 180 days from the sale of the original property. This means you must close on the purchase of the replacement property, so the new purchase property within this time frame. So that's also very important to know. So once escrow closes on the first property, you have 180 days to buy your second, I mean, the property, right? The replacement property. A lot of times, let us say if the seller thinks this is going to be hard or they haven't identified anything because they have 45 days to identify, they kind of push the escrow and they make sure it doesn't close early. They closes later. That way, they kind of gain some time to kind of look for properties and so on. A few more things regarding like-kind exchanges, which are important. So a qualified intermediary or a 1031 exchange facilitator must hold the proceeds from the sale during the exchange period. So the taxpayer can never ever have control over the funds during this exchange process. That's very important to know. To fully defer capital gain taxes, like on the gain, right? The replacement property must be of equal or greater value than the one sold. If the replacement property is of a lesser value, you may be taxed on the difference, which is known as a boot tax. Another thing which could trigger a boot is if there's any cash or debt reduction during the closing of escrow. So if you receive any funds in cash or your new replacement property has a reduction in debt, that could also trigger a boot. There is the
Okay.
same taxpayer requirement, so the one who sells the property must also be the one acquiring the replacement property. So for example, you're a partner in a partnership, you have other partners, you're a member of it, right? If the partnership sells the building, you can't individually go and buy a replacement property because you got cashed out. The partnership has to be in the exchange, and the partnership has to buy the exchange property, right? Because the partnership is the legal entity, which is the owner and the seller of the relinquished property. So that's important to keep in mind. And how do you report this to IRS? Obviously, report this with your tax return. It's on a form 8824. I'll be happy to help anyone who has a like-kind exchange and help them obviously file that and advise them. So just to summarize, these 1031 rules, they help investors to defer taxes and reinvest their gains. They help them grow their investments. And again, the deadlines have to be honored. And then one thing I want to mention is once you do this, you defer taxes. What happens is your new property you're getting, right? The replacement property, the tax bases are lower because you have deferred gains and you have to lower the basis of the new property with that gain because you haven't recognized that tax. But one thing to keep in mind is when someone inherits property, the property basis is typically stepped up to its fair market value at the time of the original owner's death. So there might be low tax basis, but once the heir actually gets the property, they get step-up basis. So rather than using the original owner's purchase price or lowered cost basis after depreciation or any like-kind exchange, the beneficiary will have step-up basis of the real estate property they received. So it's an interesting thing to think about because you might have one generation which actually depreciated the property per the tax code. They did their like-kind exchange. They kept their real estate, and then the kids got it, and they get step-up basis. So that's interesting to know.
That's crazy.
Yeah.
There's so many states, obviously, people are investing in. You're based in California. Are you able to do taxes for people in other states or just California?
Good question, JJ. Yes, definitely. We do have clients all around the state. The United States, in
And not
different
only that,
states.
but like I'm here in Southern California, but I've got investment properties out of state.
There you go. Yeah,
So
yeah, yeah,
you could do taxes for
definitely,
people that are not only not in
definitely.
California, being
Correct.
in other states, but also with their portfolio occupying multiple states as well.
So it's very common that um, obviously most of our clients are California residents, but they could have investments all around the state, as you said, in Wyoming, or it could be in different states. And yes, we could help them out with that. It doesn't need to be California residents either, so they could be living in another state, and that's fine too. We even have, foreign investors or, foreign taxpayers as well. So yeah, we actually have clients all around the world, but mainly California clients.
That's awesome. Now let me ask you, I think you said that you or your office also helps people file their LLCs, correct? Create LLCs for your investors. Is this something that's common across accountants, or are you a rarity in that your office does LLCs?
Yeah, we try to do pretty much A to Z. I don't know if all CPA firms do that, but we could help our clients all the way from, from the beginning, incorporating them, advising them what legal structure they should have, even helping up with setting up their bookkeeping. We could act as their in-house back office. So we have clients where they like to do their management, but they don't want to give it to management company, right? They want to do their own management, but they don't want to deal with accounting. We could be their back office. We could deal with their rent rolls. We could we'll deal with their receivables, their payables. So we could actually do the accounting as well. And obviously tax advisory, tax planning, and tax filing. We could also help with compiled and reviewed financials if a client needs help with that because we're at CPAs. So yeah, we try to kind of be all in one place accounting for.
Now, with that, I know a lot of people use attorneys for various things as well. Um, what about trust? I know we talk about LLCs. A trust, and you and I have talked about trust before, but trusting to go through an attorney, is that correct?
That is very correct. I would always advise to set up a trust that you go through an attorney. They will obviously set up a trust. Let us say if you want to be able to have a revocable trust, they'll set up a living trust. You can always make changes to it. And they will advise what to do. Obviously, once you set up a trust, a living trust, you want to make sure the grantee of the real estate you own is under the trust, or if you own any entities or LLCs that the ownership is it's assigned to the trust, the living trust. So, but again, when it comes to trusts, I would refer to an attorney, a trust
Oh, yeah.
attorney, right? Because all attorneys don't do everything. A
Correct.
trust attorney, yes.
Okay, we had a couple questions here. Rob Howdigy, you were on with Nareg Niazi. What's your question?
Hey, Nareg, how are you?
Hey, Rob, I'm good.
Hey, I had a quick question. So as a new investor, and then I've been doing this 5 months now, so I'm going to be rolling into the new year, and I haven't made any deals yet, but plan to after the new year. But how buttoned up should I be at this point, with aside from having my LLC established?
Is it a rental property?
I have no properties whatsoever. I just want to know, as a real estate investor, and to ready to platform myself, I just want to make sure I have everything aligned and associated with the right
Yeah.
CPA, whether that be yourself.
Thank you. Yes. Now just focusing on this part, because I don't know if you have any other income, but if we just focus on this real estate portion, yes, it's a good start. You have an LLC. You want to make sure once you buy the property, if it's gonna be a rental property, I advise strongly that you buy it under an LLC, right? Because
Right.
you will have the liability protection if, God forbid something happens, someone slips. It's
Right.
always good to have the rental under one LLC. I typically advise bigger buildings, bigger properties that each property you have a separate LLC, right?
Right.
But let us say if there's small entities you might want to, or small properties, you might just want to have one holding LLC and keep them all in one LLC. But that's a good way to start, yes.
Now, is there a maximum as far as how many properties under one LLC?
I like to have each rental property in their own separate LLCs, but that could also be costful, right? So I think that's something to consider as you go, and you could always change that because it depends. Are we talking about one condo? I mean, what is the value of the condo, right? Or it might be an expensive condo, then maybe just one separate LLC. Or if it's a rental building, like an apartment building, then definitely you want to have them in separate LLCs.
Okay.
So,
Okay, got it. So you can essentially customize it.
correct. That's a good
Nareg,
question. That's a good
if
answer.
I could jump in here,
Yeah.
one of the things that I've heard over the last 6 years of different various education groups, Rob, is that if a client or customer happens to get injured upon your property owned by your LLC, they could sue that LLC for everything that LLC has. So if you have 6 properties in one LLC and someone gets injured, they can go after all 6 properties, which is why it's best to put each individual property under its own LLC. You know, there are
Got
going
it.
to
And
be
that's
there are going to be costs with that, but those costs should be the cost of doing business, and you should be able to have those costs written off as a business expense towards each of those entities. Is that correct, Narek?
correct. That's correct, JJ. Yes. And that's kind of why I prefer them to be in separate entities, separate
Oh,
legal
no.
LLCs.
Yeah, it's all brand new to me, but that makes complete sense. Appreciate it. Thank you.
Now, Rob, the only way, I'm not gonna say the only way, and again, I don't know as much as Narek does. I'm just kind of throwing stuff out here. The only difference where you might have multiple entities under one umbrella would be as if a trust held all your properties.
Okay.
Now, what happens there is, in California, you have a state franchise tax fee, which is $800 per LLC per year. But if the property is held by a trust, then you don't have that fee. But you'll have to talk to an attorney. I know one, Narg knows one. You talk to Narg as well about what some of the benefits are about having, like, all my LLCs are owned by my trust. So I have an
Uh,
umbrella.
There you
Got
go. Exactly. So, but each rental is directly owned by one LLC. And I think I like that setup. The grant deed has its own LLC. You have the liability protection. And there's each state has its own rules. So we could look at it. But for example, as JJ mentioned, California has a minimum franchise tax fee of $800 per LLC. That covers rental income of 250,000 per year. So once that goes over, and you have more than 250,000 in rental income per year, then the 800 is not enough. Then if it's up to half a million for a building, that's an apartment building, you have to pay another 900. So these are the things you have to kind of customize and see, because if it goes over, then you might say, why don't I just have another LLC to own that property?
Right.
So it's kind of California is based on the revenue per LLC. And then if it goes over half a million, then you pay the 800, then you pay another 2,500 up to a million in rental revenue. We have those LLCs too, where we have clients where their rents might be close to $1 million. They have to pay the 800 and the 2,500. Each state has its own rules. We have to look at it, case by case and then entity by entity.
Right. Yeah. Wow. I appreciate it, man. Thank you for the insight.
Rob, one of the things we frequently get told is to put our team together. And our team is not just our contractor, it's not just our framer, our electrician, but it's also our accountant and it's our attorney. So it's good to find someone to talk to, ask a question to, whether it be an accountant or attorney, just to get some understanding so that as your business grows, you're generally laying the foundation for having, as I always say all the time, chase the relationship, not the deal. And
Right.
this way,
Absolutely.
ask someone some questions, get to know them. And being that you're in Southern California, Narg may be a good person for you to reach out to. If after the call, of course, if you have any
Yeah.
questions about anything accountant related, tax related for your business entity.
I appreciate it. Nari, I'm just over the hill in Pasadena. So
There you go. We're close. You guys have good food there.
I'll be in touch.
Thanks a lot,
Sounds
Rob.
good. Thank you, Rob.
Hey, thank you.
Okay, we've got a young lady coming on. Alicia, you're probably going to be our last question. You're on with Narg. What is your question?
I was just curious, if you need, when starting out wholesaling, if you need an LLC right away to get started or not.
If you're not holding on the property for a long period of time, right, where you're owning it and you're collecting rents on a regular basis and there's a lot of activity going on, in that kind of an instance, you would want to be in an LLC. But if you're just signing a short-term contract to then turn that property over to someone, you're going to wholesale it to a rehabber, say, for example, who's going to take that property on for a prolonged period of time. They're going to want to have it in an LLC because they're going to have contractors there, they're going to have workers there. People could be injured on the property.
Yeah,
that
the only
was-
reason I want to say maybe you want an LLC, and that would be actually an attorney question, but it would be the liability aspect, right? If for some reason something goes wrong and they want to go after you personally, an LLC might protect you. But again, this is kind of an attorney question. But
definitely.
I want to say related to taxes, not necessarily. You don't need to have an LLC if it's related to taxes, but if it's for liability protection and you want to flip this property, then maybe.
Okay. Thank you.
Well, Lisa, thank you so much. Okay. Well, Narg, we've got some great questions. You dropped some great gold nuggets.
Thank you. Yes.
And we've got Raphael coming with a question.
Hey, so my question is, it's kind of similar to the one that she asked already, but so if I'm, let's say, wholesaling and I'm wholesaling under my name, compared to an LLC, who pays more on taxes at the end of the year?
So if I understand correctly, by wholesaling, you mean you buy a contract or you buy a property,
Yeah.
right? And you
Yeah.
sell it. It could also be if you flip it or you build it or you
Correct.
flip it. Uh, t- Tax-wise, I want to say it won't make a big difference if it's
Okay.
under an LLC or not, because the LLC, you're still it's considered a disregarded entity for federal tax purposes, which
Okay.
means it's still a part of your individual tax returns. Okay. But
Perfect.
again,
Okay.
because of the liability aspect, it might be good to have the LLC, but I would probably check with an attorney.
Okay. Perfect. Thank you.
Yeah.
I have another question, if you don't mind.
Sure. Go ahead.
Yeah.
So if I have a seller that is interested in selling an apartment building, and he's trying to do 1031 exchange. I know you mentioned something about it, and he's basically trying to avoid taxes. He doesn't own nothing on the property, and he wanted to just put the money in a different property just to not pay. Um, how can we avoid doing that without him having to like go and do the 1031 exchange? Would it be selling it for less than what it's worth? Because right now he has it for over $1 million and it's only worth like $500,000. Is that even a question for you? No, I don't think so, huh?
No, that's okay.
Yeah?
I just want to make sure I understand it correctly. So, if he sells the property, it's 500,000, right? The process would be about 500,000.
No, he doesn't owe anything. It's free and clear. So it would be let's say that I pay him $1 million, right, for the apartment
Okay.
building.
So the fair market price is about $1 million. How much is his basis, like tax basis? Like how much did he purchase it for? How much improvements did he put into it?
Well, he's been owning it for a long time, and I think he bought it for like 200,000.
Okay, so he definitely has a big chunk of money in capital gains.
Yeah,
Um, and again, if it is it a rental property? Is it a business property or is it the main home?
correct. No, rentals.
Okay, because main home has main home exclusions. That's why I was asking. And you could get up to $500,000 in exclusion if you're a married filing joint
Okay.
taxpayer. But okay, so if it's a rental property, I want to say the best option is a like-kind exchange. Yes.
Okay. Perfect. Okay. Sounds good. Thank you so much.
If it wants to defer the taxes and not pay them, yeah.
Correct. Yeah.
It is.
Raphael,
Okay, awesome. Thank you.
for joining us. So, Narg, great gold nuggets. Great gold nuggets.
Thank you, JD.
Again, so you'll do taxes for real estate investors live anywhere around the country. Is there any state that you would not do taxes for someone residing in?
I don't think so, no.
Okay, so you're pretty much wide open to help anybody that's
Yeah.
looking for help with their tax stuff.
Yeah.
If people want to get a hold of you weeks and months down the line watching on YouTube, what's the best way to reach you?
I want to say probably just my phone number, 818-956-0027. It's here. Or if they shoot me an email, my email is nareg@niazicpagroup.com. And I will make sure I reply fast.
So here's your website here, right?
There you go. Thank you.
Niazi CPA Group.
And we have a contact us link there as well if they want to go through the website all the way on the top.
So here's your email, your company office number, your address, various services that you guys provide. I want to thank you for coming on to speak and sharing some gold nuggets.
Thanks for having me.
My pleasure.
It was
I got
fun.
got one last question for you. You've introduced me to the contractor helping me with my house, right? You've introduced me to people that are helping me with various aspects of my business.
Yeah.
My question is, I have a networking group, and there are many real estate education communities out there, very many communities to learn for a wide variety of professions, but in particular, talking about real estate investment. There's so many investors coming every single day to these educational communities that are brand new to investing, or some of them are very experienced investors. But each education community has a Facebook page for their student body membership. So people are coming to these groups, being introduced to the concept of using social media to network and build their business. A lot of them walk right on past that opportunity. You deal with all sorts of professions, being an accountant, probably dentists and lawyers and, contractors and friggin' everything. In your opinion, what is the importance of networking, leveraging social media to the success of someone's business, whether it be real estate or anything else?
I think first of all, to be a people's person, just a connection, networking. Um, but except expertise, I think it's very important to earn the trust, like earning trust of people. I think that's hard to get. And once you earn trust, usually it's very hard to lose that because that's not, one day's work. That's not 1 year, 2 years. I mean, that's a long term. And that's how I like to work with people in general, not just, my clients. It could be my doctor, as you said, my contractor, anyone, like long term. Just think long term and earn that trust and be honest.
There you go. Hey,
Yeah.
thank you so much for joining us today. If you guys are watching on YouTube right now, please like Nareg's video. Please put in the comment section what your takeaways were, what you really thought, which one of the rules stuck out to you, the Augusta rule, the other various rules we talked about. If you'd like to get a hold of Nareg, again, it's going to be through his website, which is Niazi CPA Group. That's Niazi, Niazi CPA Group.com. That's his website. If you want to connect with me, get into my group, click the turquoise QR code here. Takes you to my website. You could register. If you want to see our previous videos from our previous interviews, come here and scan the blue QR code. It allows you to subscribe for my YouTube channel. You see all the 300 videos we have there and everything coming up in the future. Again, if you guys watch on YouTube, thank you so much. If you guys are on the call, don't go away. We're going to have a quick little private goodbye and say thank you to Nareg. But Nareg, as far as everybody out there watching in the land of virtual networking, YouTube, Instagram, Facebook, LinkedIn, all that stuff, we'll see them in the future down the line, right?
Thank you.
Thanks for joining us, guys. See you soon.